So breaking news, mortgage rates plummet. And in this video, I'm going to be showing you what to expect from 2024. So in an extraordinary turn of events, some of the UK's biggest lenders are slashing their interest rates. Now, what does this mean for you? Whether you're a first-time buyer, a property investor, or somewhere in the middle, we are witnessing a significant drop. But why should you even listen to me? Well, I have built a multi-million-pound property portfolio from scratch and established a national house buying company. So trust me when I say I know how to make money in property, no matter what the climate, because I can spot the opportunity. The big lenders. Last week we had Halifax and HSBC drop their rates. Some of those deals were looking to be below 4%, which is very, very good. What's interesting is that means we're actually close to rates that people were previously had. Now, while interest rates went to 0.1%, not many people actually got deals at that rate. The average was about 3%. So we're quite close to where we were, and that's good news. That's great news for the 1.6 million people that are about to drop off a fixed rate mortgage this year. And I think more competition will ensure rates come down even further, maybe close to what they were before. And that will make a very big difference. On average, they're down 0.82%, so nearly a whole percent, which is very, very good. It's not perfect, but it's moving in the right direction. Now, the Bank of England's rate is going to come down. I don't think that you're going to get a rate that you can borrow at dropping significantly, but much more, I reckon there's about 0.5% left to go. I think when the Bank of England gets down to a 3% rate, you're not going to be seeing 2% rates. I think you're going to start seeing 3.5% rates, and it's not going to drop massively more than that. So a 2-year deal will get you through this slightly raised interest rate period, and hopefully in 2 years you'll then have way more realistic interest rates to be looking at, more products. For those people that like certainty, that is your certainty. Now, let's say, for example, your deal comes to an end in January, February, or March. In that time, rates could do a shift. So why now? It's a strategic move. Their lending is down by approximately 20%, and they're keen to get back in the game by offering more attractive rates. They're not just being generous, they're fighting for your business to try and get the economy restarted. Now, they're doing this to prompt you to take action and consider refinancing and buying more property. So is this an opportunity? Well, yes and no. It is positive, it's a positive signal, a shift in the market. But there's lots more to talk about when it comes to this. If you are enjoying this video, make sure you like, subscribe, and hit the notification bell. Remember, every like, subscribe, and every bell notification you hit, they all matter, and they all help me to grow my channel, reach more people, and most importantly, you tell me if you find this content valuable, put it in the comments and I will respond. So back to the point, we're seeing lenders like Barclays and Santander slashing rates, but it's not without complexities. When lenders drop their rates, it's a sign of several underlying factors: economic trends, market predictions, and even a bit of corporate strategy. Now, they're trying to stimulate the market to encourage borrowing and, yes, regain some of the ground they've lost in recent times. Barclays are a heavyweight in the lending arena, and this has made a significant move by reducing their rates. They've launched a 2-year deal with an interest rate of 4.17%, accompanied by fees of 8.99. Santander is also making waves with their new offering. They're introducing a 5-year deal at 3.89% with fees of around 9.99. In a landscape where rates are teetering around 6-7% just a year ago, this is a significant reduction. Now, like I say, it is an opportunity, and it isn't, because both Barclays and Santander are targeting a specific segment of the market, the remortgage market, those with substantial equity in their properties. It's clear that these deals are geared towards individuals who are considering refinancing or remortgaging. So if you're a first-time buyer, these products might not be the ideal options unless you have a significant deposit, and who's got 40%? However, for many existing homeowners, these offers could be the key to better financial positioning and give a lot of people relief. So what does it all mean for the broader market? For starters, it signals a potential shift with these lowered rates, we could see an increase in property transactions, more refinances, and perhaps a more active housing market. However, the caveat to that is that these changes are occurring in a global economic context that is still recovering from recent upheavals, inflation rates, global trade tensions, and other economic indicators. They're all playing a role in what's happening and the decisions lenders are making. And as a property investor or a homeowner, it is crucial for you to keep your finger on the pulse with these broader economic trends. Moreover, this rate reduction could be a precursor to more competitive offerings in the near future. Lenders are clearly signalling that they're willing to fight for your business, and this competition could drive rates down. However, it's also a reminder to be cautious. Low rates are enticing, but they're not the only factor to consider when making property investment decisions and mortgage rate decisions. My thoughts on this is to approach these opportunities with a balanced perspective. Consider not only the rates, but also the terms, the fees, and your long-term financial goals. For those of you coming off fixed rate mortgages, this could be a golden opportunity to lock in a lower rate. But remember, the mortgage market is like a living, breathing beast. It's always changing, it's always evolving. So keep your eye out on the market trends and don't hesitate to seek advice from those in the know. So this is what is going on. The Bank of England are meeting this week. The Bank of England are not going to say in March we're going to drop interest rates. The reason being that if you were refinancing today and they said, look, in March interest rates are going to go down by 2%, then you wouldn't do anything today. You would wait. So they're not going to tell you when they're going to drop rates, but they might subtly hint that something could happen this year, and that they feel we've peaked in inflation, and all of this stuff is important to listen out for the subtle undertone messages. So what else can we expect from 2024? Hopefully a stabilisation of house prices. The prediction indicates that a downward trend in house prices, which has been significant since early 2022, is expected to level off by the end of this year. The anticipated total decrease in house prices from their peak is estimated to be around 15 to 20%. This stabilisation suggests a shift from a buyer's market to a more balanced market where prices are neither rise rapidly nor fall rapidly. Number two, an increase in rental prices. So the trend of rising rental prices is expected to continue in 2024. This is attributed to a combination of factors such as limited supply of rental properties, historical trends of gradual rent increases, and economic factors like inflation. The mention of rental price of a 3-bed property doubling in a specific area from 2016 to the present highlights the significant growth in rental costs. Changes in the landlord sector with the proposed repeal of Section 21, which allows landlords to evict tenants without specific reason, and improvement in the legal process for Section 8 evictions for reasons such as rent arrears. It is anticipated that the exodus of landlords from the sector may now slow down. This change could then stabilise the supply of rental properties and potentially lead to a more regulated and fair rental market. Number four, council tax reforms for HMOs. So there is an expectation that the government will amend the rules regarding council tax for HMOs, houses of multiple occupation. Currently, individual rooms in HMOs can be taxed separately, leading to higher overall taxes. The prediction is that there will be a shift back to the single banding for an entire property, which could significantly reduce the tax burden on HMO landlords, increase their net profits, and possibly that's going to have a positive impact on tenants as well, depending on your landlord. Number five, the facilitation of converting houses into apartments. The prediction includes a potential change in the permitted development rights, making it easier to convert a single house into multiple apartments. This change is particularly relevant in high-value areas where such conversions are currently resisted by local councils. It's anticipated that these reforms will open up opportunities for property developers, especially in regions with higher land values. And number six, the easing of EPC ratings. You've heard me talk about it before. The expectation is now that the government will delay or modify the requirements for properties to meet a minimum EPC rating of C by 2025. This relaxation could make for a broader range of properties, especially those with lower EPC ratings, more attractive to investors. However, The advice is still to aim for a higher EPC rating when refurbishing properties, anticipating for future regulations. So I hope you've enjoyed this video. If you have, please make sure to like, subscribe, and hit the notification bell so you don't miss any of my videos. And if you want to get educated by me on all things property, then please visit my website, katywilsonproperty.com, and that's K-A-T-Y, where you can find a world of value in my training events and my property education and support system, Property Connect, where for the price of less than a cup of coffee each month, you can explore a massive amount of content and value and get the support that you need. Thank you for watching my video. Please comment with your thoughts, as I do read all of them, and it helps me to shape what I put out there and help make the channel more valuable for you and show you what you want to see. I just want to thank you for watching my video. I've been Katie Wilson, and I will see you in the next video.